Okay, comfortable? Great, have everything? Brilliant, right. Order. Welcome to this session where we are looking at financing the real economy. So I'd like to thank the witnesses for joining us today. The government has made economic growth its number one mission, and it's aiming to secure the highest sustained growth in the G7. But the UK has consistently lagged behind its peers, and in 2025, the IMF projected UK growth at just 1.2% below most major competitors. And the low investment is at the core of this challenge. So we want to hear from you about what your thoughts are today. And the purpose of financing the real economy inquiry aims to examine the causes of the persistent underinvestment in the UK and explore how the UK can raise capital formation by mobilising greater levels of private and public finance, both domestic and foreign, into British firms and infrastructure. So welcome. So my first question to you is, how would you assess the UK's growth outlook compared to its G7 peers? And perhaps I might go to you first, Professor Jonathan, if that's okay.
Thank you very much, and thank you for inviting me along. Not hopeful, I'm afraid, is the answer. There are some good things going on, there are some bad things going on. Some of the good things would be things like planning reform, which are increasingly important in an intangible economy. But some of the bad things that are going on are additional labour market regulation, which are really bad. So let's see more of the good stuff. And let's see a bit less, I think, of the other stuff. Otherwise, that will go away. I'll say one more thing, if I may, which is a feature of the economy in the previous decades before the pandemic, was that the public sector was net neutral in terms of productivity growth. Since the pandemic, the public sector, in particular health, has been a drag on productivity growth. So I think if one's objective is productivity growth, reform in the public sector is incredibly important, especially, as I say, on the health side. I'll stop there. Thank you.
Thank you. And if I could get initial thoughts from yourself, Lord Turner.
Well, it's difficult to be terribly optimistic. I think you've got to break it into two things. Are we in the position to change the disappointing pattern of the last 15 years? And where are we, this year, next year? The fact is that although all major advanced economies have disappointed in the last 15 years compared with the previous 15, the UK has been more disappointing. That disappointment factor has been bigger. We have fallen further below trend than either the US or indeed Europe in general or most of our European countries. So, why did we perform worse than those other countries over that period? I think there was we were more exposed to the financial sector in the global financial crisis because our financial sector was a larger part of GDP. That was a bigger hit to us. And we either needed to recover the growth in that or we needed to reallocate that to other sectors of the economy. I think Brexit did do harm, and I think we are now struggling with the fact that we are in a world of trade pressures and the American protectionism in an environment where we are more exposed than most other countries in the world because we're not China, we're not a country of 1,400 million people, and we're not in the European Union single market. I mean, to be in a world of protectionist activity when you're not got a continental scale economy in yourself or not part of a continental scale economy is a disadvantage. So can we change that? I don't think we're going to be able to change it quickly because I think, those factors are deep, and then there are still deeper factors about why our investment has lagged other countries for a long period of time. But if I was to switch to this year and next year, I think we do have to accept that I would say that we are currently held back by a lack of confidence in the economy. So I talk with several hats on, but one is as the chairman of a bank called Oak North, which lends money primarily to the mid-market, lower mid-market sector of the economy, with a large exposure inevitably to property, to the healthcare sector, to the restaurants, etc. And we have lots of capital and we have lots of liquidity and we want to lend. And at the moment this year, the demand for our loans is down compared with last year. Now, what do I think is going on? No, it's not. It's not down. It is not growing as fast as we anticipated, and not growing as fast as it was last year. And what do I believe is happening? I think the unresolved fiscal position is a short-term problem. I think having a situation where everybody knows there is going to have to be a significant element of fiscal tightening because of the debt situation, but nobody can work out where the Chancellor will do that, just creates a wait-and-see uncertainty. And to be blunt, it would be much better if last year the new income government had the guts to increase either income tax or VAT or employers' NI, one of the big three, because if you exclude the big three, you create an environment where everybody's thinking, well, is it going to be this? Is it going to be that? Is it going to be this? And what you do in those circumstances, as a business or as a consumer, you just say, let me hold off spending, let me hold off making a decision.
Thank you. Professor Tera, where do you think? How are we doing?
So I would echo a lot of comments we've already heard. The policy stability or lack of is an enormous issue. Uncertainty of any kind creates a block on investment, and investment is what we're here to talk about today and is a real problem for UK's productivity and growth. I want to highlight something that is a little bit positive, which is our population is not aging quite as fast as the Italians or the Germans. And so there's a little bit of extra potential in terms of workforce participation that we will be able to get over the next couple of years. Of course, other targets that the government has are per capita. So in that sense, they wash out a little bit. So I think that's a positive that we should maximize as far as we possibly can. But McKinsey Global Institute research, for example, is very clear that participation isn't going to be anything like enough to get us to the sort of growth numbers that we would want to see in a few years. So we need labour productivity. And as we'll come on to talk about, UK's labour productivity performance has been very bad. And while AI might produce some beneficial outcomes in the longer term, I think in the short term, we haven't seen the kind of investment that we need to boost that. I specifically want to emphasize the lack of business dynamism in the UK, which I think we need to understand in order to understand this investment problem. What do I mean by that? So in the last 15 years or so, the bottom half of all businesses created zero productivity growth. So all of the productivity growth was basically created by the top half, which we really need to champion and encourage. When we asked businesses who made significant investments into the UK, only 10% of them said they were actually risky investments. Again, we need risky investment from businesses in order to drive innovation, to drive productivity, to drive exports, to drive all of those kind of beneficial things in the economy. And so when the government is thinking about the sort of tax or planning or indeed spending environment, it needs to be thinking about how do we encourage risk-taking and how do we encourage that private sector investment. Final point I'll make on it, but we will come back to it. It links into Jonathan's point about public sector productivity. If we can spend some of the money that is limited on investments that unlock private sector investment, whether that's because we're unlocking some transport bottlenecks or we're increasing the energy connection capacity for data centers or whatever, we can actually sort of get a multiplier effect going. So that's the positive, hopeful side of the story.
Thank you. And last but not least, we come to the screen. So Professor Jagjit, we've got not very good outlook here. We've got issues with productivity raised. We've got a lack of stability in the policy environment. What would you add, or would you come in and say that everything is fantastic? Where do you land on? How are we doing as a UK? Now, we've got an issue with sound. One moment, Professor Jagjit. You want to try again?
Yes, thank you very much for meeting. And
thank you
as well for allowing me to give my evidence online. It's not my preferred way of doing it, but I'm constrained for a number of reasons at the moment. So thank you very much and for your patience in allowing me to do this online.
Thank you.
Look, I'd love to tell you everything was hunky-dory. It's not. It's far from hunky-dory. If we were marking the UK economy in an exam, I'm afraid we'd fail it. It's failed on nearly every measure since the financial crisis for the reasons that my esteemed colleagues have already outlined. So I don't want to repeat ourselves. And this has stirred a huge level of disappointment in the country, both relative to expectations, but also in terms of actual performance. which then brings us to question almost immediately the government's target for growth at the highest level in the G7. Well, you can grow a bit faster, but unless you do it for a very long time, your level of income will not make up for the shortfall we've suffered for the best parts of a generation now. So we need to look at the actual levels, not the growth rates. And of course, the growth rates are highly choppy, highly volatile, and difficult to measure across countries and subject to extreme revisions. So I think a better target, but one that you can't hit in the short run by any circumstances, is to think about things like income per head and how that has performed relative to our trading partners and relative to our expectations. The point was that if you drew a line at about 2008 and asked people or did an econometric analysis, dare I say, or projected where we thought income would be today, all those lines would suggest income per head would be some 15 to 20% above where it currently is. And I'm not saying it's the unicausal explanation, but it's the thing that really helps us understand why people are so upset around the countries. There's a sense of having lost a generation and nobody really understanding how we're going to catch any of that back. And we need to be clear that building up again is going to require investment of the type that Jonathan, Adair and Tera have talked about, but it's going to take time. I think Tera herself recently authored a paper saying it's going to take the best part of a century to build up capital. I think it's more like 40 to 50 years. But I'd be terribly happy if the current Chancellor were to stay in post for 40 to 50 years, if it helped build up capital to the kind of levels that we want. And of course, one of the problems is that, and everyone's alluded to this to some extent, is that we have such high policy turnover and uncertainty in this country. I did a quick mental calculation just now. I think we've had something like 9 chancellors of the Exchequer since the financial crisis, an average tenure of around 2 years, less than 2 years. Kind of no wonder that no one takes responsibility. If I were Alan Sugar, but I'm not, I'll be asking who is responsible for the failure of this task, because it's been an enormous economic policy failure on behalf of the UK. And we absolutely need to pick up the pieces and stop sort of dancing around it merrily and sort of saying, well, we'll sort it out with a bit more money here or a bit of a tax on wealth. This is a huge, huge issue that needs to be addressed. I think I could go on at the risk of boring everyone, but I'm sure we'll deal with some of these things in detail as the witness session continues. So I'm going to stop there, but I want to get across is the large and extended nature of the problem that we face. It's a generational, existential issue that I really think all parties and all people ought to get behind.
It sounds as though time is of the essence and we've lost too much time already. And hopefully, as we go through the rest of the questions today, we will get some ideas and some thoughts about how we do turn that oil tanker around. I'm going to now turn to Josh for the next question.
Thank you, Chair. To get the investment is critical in productivity and long-term growth, we know that. Yet investment in the UK is one of the lowest in the G7. So is the level of investment in the UK enough to facilitate the economic growth that the government is aiming for? And if not, what do they need to do, Professor?
So it's nowhere near enough. So we invest about 19% of our GDP as a kind of ratio. Other countries are more like 22. That's 3 percentage point difference. We're at the bottom of the league table, and we'll come on to talk about the capital gap. But because it's been going on for decades, there's a really important thing to understand about capital. It accumulates and it depreciates. So if you do not invest more than what your capital is depreciating by each year, you're not actually growing the capital base, which then helps your people be more productive. And so in our paper that has been mentioned already, we try to put this into the quantum of, well, how much capital are we today lacking in the economy? And we came up with a number of £2 trillion. So when the government says they're going to invest 10 billion here or even 100 billion there, it's still not a quantum that's enough to get us to the kind of real league of more productivity, higher productivity countries. Indeed, we need to raise that percentage of GDP investment by several percentage points, as Jagjit says, over several decades in order to actually make a dent in this problem. And we'll come on to say about what sorts of things we could do to really move that needle.
What do you think the government should be doing to try and encourage that? Because it's going to need to go significantly above the G7 average in order for us to start closing
Exactly. In order to start closing the gap, we need to be above the average. So there's many things that have been already alluded to, but most importantly, you need to take away barriers from investment. What does that mean? Planning and permitting and all kinds of regulations that add risk to private sector investment. That diminishes the capacity and the willingness of private sector invest. So that needs to be a radical reform, not an incremental thing. Public sector investment itself can be much better targeted to coincide to bring in and to crowd in private sector capital. So I've looked at the £100 billion the government in the spending review says it'll spend roughly each year on capex. Only a third of it has anything to do with growth, such as removing transport bottlenecks or whatever. So either we need to borrow more and spend more, or we need to redirect that capital to be much more growth oriented. I think we need to do something about this business dynamism issue. I don't know yet exactly what the answer is, but there's a sense in which we allow businesses that are not very good to survive and continue to subsidize them even through the tax system and through NICs. So if I take an example from the US, 1 full percentage point per year of productivity growth in the US comes from letting businesses fail and the businesses that are succeeding take over their market share. We didn't even have 1 percentage point of productivity growth full stop in the last 20 years. So we need to figure out ways in which businesses feel more able to take big risks, more able to fail if that needs to be the case, and more creative destruction to take place.
Lord Turner, can I ask you, what do you think the government should do to try and get that investment? Anything in addition?
Well, I don't have any magic answers, but let me suggest two things which I think are important to this whole debate about productivity and investment. One may surprise you, but it is our taxation of property, which I think is a complete and utter disaster. We have an incredibly low level of property tax on staying put, i.e. council tax, and we have an unbelievably high level of taxation on moving around, which is stamp duty. In a rational world, we would very, very significantly increase the higher rates of council tax, possibly by as much as 4 or 5 times, and we would slash stamp duty to a minute fraction of its current level. I mean, I know this personally, sitting on a large house in Kensington after my daughters have left. I ought to sell it and release it, and I don't, because I'll lose an enormous amount in stamp duty when I trade down. And the council tax that I pay is, for me, so small I don't even pay attention to it. But this, in general, it is a taxation system designed to produce labour immobility. It means people don't move around. And one of the things you need for businesses to grow is for people to move around to different locations. So that's one idea. The other thing, though, is I think we have to break the investment side down into both private investment and public investment. On private investment, clearly it is the case that the levers are indirect, they're about certainty, they're about appropriate taxation, they're about planning and regulation. But public investment, the government has a greater handle on. And it's really interesting to look at things like NHS productivity. It doesn't surprise me that NHS productivity is very low because we do very, very little capital investment in the NHS. We are now actually not far off the average of a spend as a percent of GDP for the European countries of the NHS, but we're spending almost all of that on current expenditure and very little on capital expenditure. The current expenditure soared in COVID and didn't come back down again. We have a major challenge also on the investment needed for a zero carbon economy. Most of that will come from the pure private sector, but I think we are not being imaginative enough about the use of what one might call the quasi-government balance sheet. We have the National Wealth Fund, we have Great British Energy, we have the British Business Bank, but in total, these do not deploy anything out like the resources that institutions like KfW deploy in Germany. And that is partly because we take a much more purist approach to counting as public lending, borrowing, the borrowing of those, owned by government balance sheets. We could, I think, take a much stronger sort of development bank approach to those institutions and to allow them to give them equity investment from the government, but to allow them to go out in the market and borrow money. And that would enable us to increase some important categories of public investment, or some things where the public sector could play a greater role, in particular in the investment needed to create a zero carbon economy.
Thank you. John.
Thank you, Chair. And we talked about churn in chancellors there. I think there might be quite a lot of churn in politicians if we suggested increasing council tax by 4 and 5 times. I think that would be quite a tough sell. Professor Chadha, online, first of all, you seem to indicate that perhaps the government is looking at this through the wrong end of the telescope when it set its target as being the highest sustained growth in the G7. You seem to suggest that that's the wrong thing to be aiming for because it's simply the wrong target. I wonder if you could just expand on that. If it's not that target, what should it be?
Thank you very much. Yes. Growth, so unlike inflation, which we've got pretty good models and understanding that it can be controlled pretty well by manipulation in short-term interest rates, growth is a little bit more difficult to explain. You may have noticed the Nobel Prizes in economics yesterday were given to 3 people who've worked extensively on growth throughout their careers. And it's not something we completely understand. A lot of it is treated as exogenous outside the system. A lot of it is hugely complicated, a result of institutions learning skills, things that you can't change very quickly or understand. So having a target for something that you can't actually control, I think is a problem. And I think the more I think about this, and this has been developing over the year for me, it would be better for the government to focus on, I hope this doesn't sound too heretical, on a commitment to reduce our concerns about the fiscal position, reduce fiscal fragilities in the economy. Because what we've seen is that we seem to be reaching our limit in terms of our debt that we can take on, or financial markets are worried. That has led to excessive volatility in borrowing rates that is then reflected in the private sector's ability to borrow, and then also reflected in the public sector's ability to invest. We're now spending over £100 billion a year on interest payments alone on the debt. So this is a kind of indirect mechanism to creating more fiscal space and a more stable economy that would allow investment to occur. And of course, the fiscal position is by and large within the control of the Chancellor. And as Adair said in his opening remarks, a commitment in the first budget to think hard about tax revenues would have been very helpful to alleviate the concerns that we've had about the fiscal position that have very much dominated economic debate this year, that leads to all kinds of uncertainties as people are thinking, what taxes are they going to change next? What are they going to do now, rather than just having sorted it out? Yeah. And a counterpart of that is one of the reasons we're scrambling around for reasons to raise revenues or taxes is that I think the state has become too large. So I think it helps us understand why productivity is relatively low. We've increased the number of people working in the public sector to over 6 million. And if you increase the number of people, it's not a surprise that productivity is low. And what we also then need to do is think hard about where we can trim the size of the public sector. Total managed expenditure by the state is some 45% of GDP. The post-World War II average was around 40% of GDP. So if we can think hard about how to have a fiscal consolidation through a reduction in expenditure, we would also alleviate some of the fears about the fiscal position and reduce the need for an increase in taxes, which I think is part of the problem in terms of holding back investment. Because entrepreneurs and other people are thinking, well, am I going to do this? And am I going to be taxed heavily on it? And one extra point, if I may, very briefly, following on the points that have already been made. Neither the National Wealth Fund is large enough, or the 3 development banks that have been set up, to provide the level of risky capital investment that the country needs. If I take an example, the European Investment Bank, in the last 7 or 8 years of our membership, would typically lend us some £6 to £7 billion a year. our collection of development banks, or whatever we want to call them, the replacement banks we've got, in the last year that I've got numbers for, only lent £2.4 billion. Yeah. So the institutions that we put in place have not replaced what we've lost from the European Investment Bank. And alongside that, there are huge differences in regional capital allocations as well, or accumulation, with certain areas doing very well. You'll know where they are. But if we look at the peripheral regions, if I could describe them as that, I certainly don't want to upset any members here by using that phrase, but Northern Ireland, Wales, Cornwall, Scotland, East Midland, North East England, these have low levels of capital relative to GDP or GVA, which means that we're not spatially allocating capital very well across the country either. So I think there are two aspects: a low level of capital, but also a poor level of regional allocation, which we might want to turn to a proper development bank to carry out for us. But what we've got at the moment is something that's not large enough to replace what we've lost.
Thank you, Professor. And you're touching there on the capital gap, and Professor Allas, you mentioned the capital gap as well, which broad brush is the gap between the supply of capital relative to demand, as I understand it. Would that be broadly right? You might be able to keep me right.
Yeah,
on that.
so what we mean by the capital gap actually isn't the difference between the supply and the demand, and we should come back to whether this is a supply of capital problem or a demand of capital problem. My view is that an awful lot of the problem is that we don't have enough entrepreneurs and people willing to make risky investments. If we had those, the capital would flow. And we don't have those risky investments because of all of the reasons we've described: policy uncertainty, planning regulations, labour market regulations, changes to regimes too often. The capital gap that we refer to in our paper is something a little bit different. It's looking at high productivity countries, which we picked to be our peer countries, US, Germany, France, and the Netherlands, and the UK, and we literally just looked at how much capital does each worker in each country have available to help them be more efficient. So if you're an accountant, if you have a laptop, you're going to be more efficient than if you don't. If you're a farmer, if you have a combined farm harvester, you're going to be more efficient than if you don't. If you're a risk assessor at a bank and you have an AI system that allows you to figure out transactions, that's going to be more efficient than if you don't. And if we added up all the capital available to workers in the UK versus in these other higher productivity countries, we found that for each hour worked, UK workers have a third less capital, so 33% less. So in some ways, it's kind of no wonder that they're not as efficient and not as productive as their peer countries. And then we track back to why that is, and it is precisely the reasons we've already discussed, which is because capital accumulates over very long periods of time. If you have a deficit over 20, 30 years, then by definition at the end of the road, you're going to end up with this enormous gap. Now, I should say, I don't actually think it is realistically ever going to be filled. Like 2 trillion is a big number, and Jagjit and I both think it's going to be decades, and in order to fill it even in decades, you'd have to have an enormous increase in our investment rate. That's possibly not something we can do very quickly or even at all. So we then need to really focus in on, well, how do we use the capital we do have as effectively and as efficiently as possible? And I wanted to mention something that Jagjit kind of alluded to, which is it's not enough for the public sector to say, oh, we're going to spend more capital. It has to be spent in the right place at the right time with associated intangible capital. Because if you just spend it on a machine somewhere and you don't have the nurses who can operate the machine, or you just spend it on a railway piece of network somewhere, but you don't actually have the trains or the drivers. Anyway, the point being that at a really minute level, there isn't a very good system of scrutiny in the UK government. Look at where does all the money go? Does it deliver any returns? And if we learn from that, let's not give money back to the people who didn't deliver returns. Let's actually kind of reallocate quickly to those areas that are really going to deliver growth.
Professor Haskel, it sounds like we've got an enormous problem. I mean, 2 trillion is an incredible, mind-blowing number, and we're talking about decades to try and address this. Have you any thoughts on that? I mean, we're not going to solve this overnight, that's obvious, but where might we begin to head in the right direction?
Yeah, thanks. I'll say 2 things, if I may. One is I wanted to come in a little bit. A number of the speakers have talked about the role of the public sector, and as I mentioned on my opening remarks, this used not to be a problem, but it is now a very big problem, and this is part Mr. Cooper, to your question, which is this productivity problem is a moving sort of target. Here are two numbers which I find it rather helpful to keep in my mind. Since 2018, since the pandemic, 2019, we've had on average in the UK productivity growth, as you'll know, of 0.3 percentage points. It's a laughably low number, as everybody in the panel has just said. That's number one. The second number to keep in your mind is the drag from negative productivity in the health service has pulled that down by minus 0.2 percentage points. In other words, if we just had flat productivity in the health service, not growing productivity, just flat productivity in the health service, we could raise our productivity by 66% from 0.3, because we'd remove the drag of being the 0.2. And I think this is just a major issue that we need to get a grip on. That's the first point. The second point, in answer to your question, what can we do about all of this? Well, again, in the spirit of this being a moving target, the moving target on productivity has now become the public sector. The other part of the moving target in the private sector is that the drivers behind productivity have changed from the more tangible assets, ships and aircraft and cars and planes and machines and this and the other, to the much more intangible things. So what drives private sector productivity nowadays? It's more software, better design, better Harry Potter scripts, improved AI, improved marketing so that we buy stuff and all that kind of thing. So what we need to go forward, to answer your question, is we need an improved set of institutions which will help us on the intangible side. So that is around financing, which Adair has talked about and your chair talked about in his article as well. And it's also about regulation in the labour market and product market as well. But I should say more, but I'll stop there.
Thank you. Yeah, Lord Tera, briefly, any thoughts? Where do we begin? Are you in agreement with that? Better Harry Potter scripts?
Well, who could be? Well, no, I think the Harry Potter scripts are pretty good already. So, unless we're going to, clone a J.K. Rowling, I don't know how we're going to do that. By the way, can I just say on council tax, I hope the record will say that I said 3 or 4 times on the upper bands of council tax, not across the record. And let me be clear that that is what I meant. Look, the question you asked first was, is it good to have a target which is we're going to have the best G7 growth rate next year? And the answer is no. That is a not helpful way of expressing what we need to do. First of all, because it suggests that there are available to either the Chancellor or anybody else levers which are going to work over that period of time. And the whole point that Tera and Jagjit have been saying is that these things take a long time to fix. Secondly, it's a target which, if you meet, you'll primarily meet because other people did badly, not because you did well. Then you're going to pat yourself on the back, but so what? And if you meet it because you went at 2.1% and France went at 2%, that's a completely so what, because the imperfections of the measurement of GDP are so great that I consider 2.1 and 2 exactly the same. So what we've got to do is get away from any short-termism and say, we have a fundamental problem of productivity. We have a fundamental problem of a lack of investment. It is going to take many years or decades to do this. We are going to slowly build towards the things that make a difference. Within the course of a parliament, that should be enabled to take the growth rate up to order of magnitude, 1.5%, 2%, rather than the lower levels that we're having. And we're going to do the institutional things that make it likely that we can sustain that decade or decade thereafter, without being all that worried about whether that is a little bit faster or a little bit slower than, Italy or Germany. And I think that seems a technical point, but I think it's an important point about tone and about being honest with people about what can be achieved. As I say, in terms of the actual specific things that we can do, I was very struck by Jagjit's numbers, which illustrated the point that I was making without numbers, which is these development bank institutions like the EIB, like our National Wealth Fund. We are playing around at the margin on these things in terms of the quantity of money that we are giving them if we want them to play a serious role in addressing this capital stock gap that we've described. So one big thing is we should just get much more serious about the use of these, government-owned but institutions with a development mandate.
Fantastic. So I think we're not sure about the G7 comparator table as our measure of how well we're doing. So what about measuring our economic growth with GDP per capita or real household disposable income? Because that's one of the approaches that the government has taken. So Professor Tera, what do you think about that? Is that better? Because, my constituents, for example, they're going to think about what their household has. It's a little bit easier to understand, perhaps. So what do you make of those two measures?
So I think they're more meaningful. I believe the government's target is that they're higher than at the beginning of the parliament, which is honestly like an incredibly low bar. As Jagjit, we used a very important word earlier. He said relative to expectations. So I don't think people in Britain go about measuring themselves against the Germans or the Italians or, even the US. They measure themselves against the people they see around them or they see maybe on social media. And what matters to them is the actual quality of life that they're able to have. And in that sense, something like disposable income per head is a decent number. However, it still has problems around its measurements. What's in scope, what's out of scope is always kind of where you draw the line. And one of the things I would say, because I also spend a bit of my time looking at things like well-being and what actually makes people happy and satisfied with their lives, there's huge distributional issues here. So we know from some latest analysis from well-being economics that if your income is more than, say, 40,000 a year, net equalized household income, beyond that, you don't actually really need any more money or you don't become more satisfied or happy with more money. And so if all of that extra GDP and disposable income goes to that part of the population, it's actually not helping the people who really would benefit from having a bit more disposable income. So I think a more smart target would be to think about people's actual quality of living and measure it through multiple different lenses, and not just the lens of money, because the lens of money, as soon as you aggregate it into a totality for the British population, it's a bit of a nonsense, because there will be people doing really, really well, and then there will be people doing really, really badly.
Thank you. Charlie?
Oh, thank you. Thanks for being here today. So just going back to the kind of public sector involvement in the economy, and, as they've stated, increasing public sector investment by over 100 billion between 2024-25 and 29-30. Then I've got a grid in front of me here, which is kind of the policy impacts on real GDP as a result of that. And, by 29-30, it's actually got a negative 0.1%, which is, what we've already covered a bit, but pretty horrific as an outcome. And to your point about a third being, in your view, useful, 2/3 not that useful, and I think you mentioned, Jonathan, a kind of framework. Do you have any directions as to who's got the best framework, who's done the best thinking about this, in terms of how public sector investment could be better directed, and any kind of directions you could give? Maybe Tera, if you'd like to start.
If I may just clarify, when I said 1/3 and 2/3. Useful is maybe not the word I should have used. If I used that, I apologise.
You probably didn't.
Let's call it growth enhancing. So the government rightfully has all kinds of other objectives. Defence is a big receiver of a lot of this capex. I'm not saying it's unuseful. It's just not necessarily going to boost growth very much, even though lots of people would want to believe it does. I don't actually believe it does a huge amount, but I do believe we need defence. Do you see what I mean? And there are indeed some of that capex goes to the public sector, like the NHS, whatever. That should help people's quality of life in the sense of, healthy life expectancy and health. Again, it's useful, but it's not necessarily growth enhancing. So that's what I meant by that point. I think the numbers in your grid, are they from the OBR's assessment of, I sit on the OBR's advisory panel, and it's fair to say there is not agreement on several different ways in which you might attack this question of how much does a certain amount of capex actually add to GDP. And there are two big reasons why. You need to make a choice about whether you believe the capex crowds in private sector capital or it crowds out private sector capital. And I believe some of the reason why the numbers might look negative at the moment from the OBR is because they believe that quite a lot of the government capital crowds out private sector capital. I actually more on the crowding in side. I think if you target it well, you're easily going to crowd in R&D investment or crowd in, machinery and equipment and skills and whatever. The second reason is capital is not a uniform thing, as I mentioned earlier. It depends what you spend the capital on. And so OBR necessarily is looking at the macro effects. But if I used to work as chief economist at the Department for Transport, we had projects that were enormously growth enhancing, and we had projects that were frankly not very growth enhancing. Even within that one department, and transport in general, you'd expect to be slightly more growth enhancing than, some other kinds of more, let's say, called defensive type investments. So it is really, really, really difficult ex ante to know. And therefore it's a bit of a misleading thing to even try to say, is it 0.1% of GDP or negative 0.1% of GDP?
Well, maybe I totally said that. Maybe focusing on the process of, is there anything we can do clever about the process as a country? And maybe, Jonathan, would you like to have a shot at that?
Yeah, thanks. I'd say two things. One is I'd echo very strongly what you've just heard from Tera, which is the point about government R&D investment is precisely as Tera said, that it crowds in private sector R&D investment. Other types of government investment are often not as successful about crowding that in and often may even displace them. So that's a very important subdivision of government, public investment, which we must be alert to. I mean, that's one thing. The second thing, I think, behind your question is, if I understand it correctly, so forgive me, Ms. Mayfield, is how do we set our fiscal rules and what's the right way to, put in public sector investment when we're thinking about fiscal headroom and all that kind of thing?
Well, actually, I'm heading there next, actually, but I was more thinking about just kind of if a third was not growth enhancing, was there any way that we could be? Who's got the best ideas on how to head towards more, using public money in a more growth enhancing way?
I defer to public sector management experts who can tell you all of that. I mean, as I say, the figures for the health service are not helpful, or not hopeful on the productivity side. It could be that other things are going on and there are other things are being measured, but on that basis, that doesn't look good.
Well, running with that on the health, who's got the best thoughts as to how to change that just on the health productivity?
Well, again, I'd happily defer to health management experts. Okay. I can find colleagues at Imperial who'd be delighted to come and talk to you about that, if that would be helpful.
Can I mention one thing about institutions, which is we don't actually have an institution that scrutinises public money in that sense on a kind of line-by-line basis. OBR does its job as a macro regulator or watchdog. It is not its job to go down line by line and look at whether it's growth enhancing or not. In theory, because I used to work as a government chief economist, in theory there's such a thing as the Green Book, and in theory every investment has to go through an appraisal, and in theory that should feed into decisions about whether such an investment is taken up or not. Slight problems include that by definition the Green Book is not about GDP, and it should not be about GDP. It's about social welfare, in other words, this kind of broader sense that people have a good life. And I think it should be like that, but it isn't going to align 100% with GDP. And the real bigger problem is that it doesn't really have any teeth. Like nobody in government, as far as know, like polices this happening. Rightly or wrongly, a lot of decisions are political, and I think rightly, but there isn't really an institution anywhere that's scrutinising that.
Right.
Thank you. And if I could briefly bring in Professor Jagjit, I'm also conscious of time and I want to make sure that we get through the various questions that I know my colleagues have got. Did you want to come in briefly, Professor Jagjit?
Yes, I'll be brief. First, I just want to back Jonathan's point on R&D. A whole gamut of research papers over the years from various micro and macro economists have demonstrated that R&D in clusters absolutely does help potential growth in an important way, and we ought to think about how to implement those. On Tera's excellent point about about the low estimates of the impact of capital on the growth, that's because the models generally used assume very little by way of an output gap. So they have a fixed level of output in their mind. So when you introduce capital investment, you're just increasing demand in the economy, and in the model, interest rates rise that stop there being an impact on growth. So there needs to be some more flexibility in the way that gets modeled, and that's why we get the very low numbers. Not criticizing the OBR per se, but I think there needs to be more flexibility on the supply side. And I think that comes back to the point that we've been hearing all kinds of drip feed arguments about is something called dynamic scoring. And that is the extent to which we think bits of public investment will help potential output in the longer run. And what we need is not the drip of rumour and innuendo. We need a serious study of it so that we can have some proper numbers and understand what public investment might do to the supply side. And one final point, which I'll try and summarise very quickly, is we also need commitments to complete public investment. We're sometimes good at announcing we will do public investment and then not do it, or start bits of public investment. If I could, mention all kinds of railway projects that don't quite get off the ground, and then not actually complete them. And that, of course, creates its own level of uncertainty. If I were an entrepreneur and I wanted to set up a business, I'd want to know with certainty that the railway line and the transport links that I require for my business to succeed will actually be laid down. I think generally I wouldn't believe the Treasury when it says it's going to invest in some part of the country, because I'm not sure it always happens. So I think there are some issues there that need to be ironed out.
Thank you. Charlie, briefly.
And Jagjit, sticking with you, if I may,
yeah.
In terms of our fiscal framework, and this is obviously lots of kind of gossip and innuendo going on over the next few weeks, if you were to kind of just say what you see as the problems in terms of that framework in which we're having to play, and any changes to that framework that you would recommend.
Yes, well, thank you. I ought to keep my answer as brief as possible. It could occupy us for the rest of the day. I think we need to accept, as I said earlier on, the framework has failed. Debt to GDP has doubled practically since the framework was adopted in 2010. So we need to understand why. Now, we've got some shocks that help us understand it: Brexit, COVID, and call it the energy price shocks in the early part of this decade. But we haven't managed to get things under control. And what we have at the moment, a fiscal framework that projects where debt to GDP will be at the end of the Parliament as a forecast. And we kind of know forecasts will tend to be wrong. So it's not really a very good way of controlling government behaviour, because the next year we get another forecast that also says we'll meet the target. And I want to make one point as well about the nature of the target. Generally, the rules have said debt to GDP has to fall in the final year of the Parliament. So you could have 4 years where it's increasing, and then the final year, if it comes down by epsilon, where epsilon is a very small number, somehow we've met the fiscal rule. But debt to GDP is higher at the end of the Parliament than it was at the beginning. This is, if I use a phrase that I used the other day, and I apologise if it upsets anyone, it's cockamamie. It doesn't bring about a reduction in debt to GDP. And it's incredibly important that we do have a fiscal consolidation. Two direct reasons. If we don't have fiscal consolidation, many entrepreneurs and other people will start to worry about what taxes will be introduced, and they will hold back activity in expectation of some radical changes in the tax regime. And if we don't have a fiscal consolidation, there is a real danger, and that's what I think the bond markets are picking up, that central banks, and this is a problem that we see in many Western countries, will feel constrained. And what we'll have is a world of fiscal dominance, where central banks cannot raise interest rates to the level that they would want to, because it might threaten fiscal stability in an economy. And I'm not saying that's going to happen. I'm not saying it's happened. But bond markets are forecasting, thinking about things that might happen in the future. And if debt levels are high, and we have governments that reverse promises to cut expenditure and reverse promises to increase taxes, which we're seeing throughout the Western world, it's not surprising that bond markets start to say, well, what's going on here? Debt is going to continue to rise. And at some point, monetary authorities may lose control of the price level, which is only going to lead to further problems down the line. So we absolutely need a fiscal framework that acts on what we actually see rather than what we're forecasting, and is able to say to ourselves, look, what we want to see over any 5-year period is a specific fiscal consolidation plan to bring down debt to GDP. And if we can bring down debt to GDP, partly by reducing government revenues, partly by increasing some taxes, which we could talk about, we're creating some fiscal space, if I could use an expression, that allows us to have some of the public investment we desperately need. The problem is we're up against our borrowing constraints.
Thank you.
It's very hard for us to have the public investments that we want.
That's excellent. Thank you. I'm going to move to Sonia Kumar next for her question.
Yeah.
Thank you, Chair. So I think the committee's already highlighted some of the evidence. So the UK's financial mobilisation lags behind we lag behind our international peers in terms of public sector investment and crowding private capital compared to our international partners. What lessons do you think we could be learning from places like Singapore? And if I go with Professor Tera Allas?
So I think it's going to be very similar to what we've already discussed, a sort of, I don't want to say policy certainty because that's never a realistic thing to say, but a roadmap towards how we're going to close the gap and how we're going to invest more and spend less, as it were, on a kind of day-to-day basis. Because generally, if you invest more, then your OPEX cost can go down. But it is also the quantum of the development banks. We've just discussed, the ones we have in the UK may well be incredibly effective, but they are incredibly small relative to the kind of quantum of the gap that we have here. And so if one were being negative, one could say they are even a distraction because people latch onto them as ideas as fixing this problem when they can't possibly fix the problem being such a small part of the, having such small capitalization. Basically, it's having a long-term plan and sticking to it. So I do want to mention one good thing, which I actually think the government's industrial strategy is pretty good. It's solidly built up from kind of coalition between private sector and public sector, and it's got a 10-year time frame. It's got a very wide remit, so it doesn't just look at things DBT can do, but what can we do all? And it's got these commitments coming in. I think it now needs to be implemented. It's got 150 different measures in it across 20 plus different departments. That's going to be a nightmare to implement unless there's some real political capital behind it. And if there isn't, then it's another example of what Jagjit has said, government promising to do something and then kind of like not really properly implementing. So I want to end on this point about implementation and execution, and stability comes from seeing is believing, right? And I think part of that goes for some of the other countries that we also compare ourselves, Germany and France, for example.
Lord Turner, I think you indicated
Did you say Singapore?
Yes.
I'm always wary of us trying to get too many lessons from Singapore. I mean, Singapore is a very, very different society. I'm a huge admirer of it. I go there a lot. I know a lot of people in the policy framework. It is a country with an enormous structural savings surplus and therefore current account surplus, which creates a certain set of opportunities and challenges. I think its institutions like Temasek and GIC, are really excellent organizations which have been given public money to invest. They are public institutions, but they do so in a ferociously analytical and thoughtful approach. It's true to realise that, of course, a lot of GIC and Temasek investments are actually outside Singapore, which is the classic approach that you have when you have a large current account surplus, but you're trying to anticipate the money you will want when an ageing society switches round the other way. But they're certainly very effectively run institutions. I did want to just come back. You asked one question earlier about GDP per capita against GDP. Look, it should definitely be GDP per capita. I mean, Tera has made some points about whether even GDP per capita isn't sufficient. But the idea that we're focused on GDP, I actually think has been a bit of a harmful delusion. You can boost your GDP by having huge immigration and, your rising population. And since 2000, the UK population has gone up by 18%, while France has gone up by 12% and Germany's gone up by 2%. There's no suggestion whatsoever that it's helped us increase our GDP per capita. And it's quite interesting to notice that since 2005, UK GDP per capita growth has been slower than Japan's, which many people think is a stagnant, slow-growth economy, but it is growing GDP per capita faster than we are.
Excellent, thank you. I just wanted to come briefly, because I'm going to try and get one more question in after myself. Professor Jonathan, intangible assets, we've heard about this difference between the amount of investment that's there between tangible and intangible, and the issue of where the UK's investment level stands. So could you give us your thoughts on that sort of conundrum and where you think we've gone wrong and where you think we need to be headed?
Yeah, thank you, Chair. As I said, in this moving target about understanding about how we're going to get more growth and investment, intangible investment has become the most important metric. And the good news is that the UK performs actually really rather well in comparison to our European competitors. I don't know about Singapore. We don't have the Singapore data yet. But we perform rather well relative to our European competitors. We do so, however, as an uneasy compromise between a number of factors. The thing which helps us is our support for universities, which, as we mentioned earlier on, crowd in private sector intangibles. The thing that holds us back is the fact that we can't form meaningful clusters in this country because we've got bonkers planning legislation, almost as bonkers as the local taxes legislation that Adair Turner was talking about. The other thing which helps us is we've got relatively open product markets. That was hurt, of course, by Brexit, but Brexit is Brexit, which takes us then to the labour market situation. And we are helped by having a relatively liberal labour market. You need a liberal labour market in order to get intangible investment. Many intangible investment projects will fail, unfortunately, as your bank, Adair, will know. So you need a labour market in order to encourage that, where it's not too costly. And where that takes one in terms of concrete policy proposals is the Employment Rights Bill is not something that I think will subtract from growth. It is bad for intangible investment, and at the current weak situation which firms are in, I just don't think we should be going ahead with it.
Thank you. I'm going to bring in for final questions. I've just got time. Joshua Reynolds.
Thank you, Chair. In that case, it's going to be the speed fire round, everybody, if that's all right. An incredibly simple question, of course. Ahead of the next budget in November, what one or two things should the Chancellor be doing to drive business investment, given the current financial constraints, if we go down?
So do not change anything about business taxation. Like, not up, not down, just stick to what you've already done and say we're going to have stability in this Parliament.
Increase either VAT, income tax or employees' national insurance, and make clear that because one has done that, there will be no need to seek further taxation from business at any time for the rest of the Parliament.
I agree with what Adair has just said, and postpone the implementation of the Employment Rights Bill until firms are in a stronger position to withstand the costs.
And Professor, online?
Thank you. Yes, I think there's some scope for broadening some of our incidence of VAT that could raise some money, but also if we look at income tax on those in the 50th to 90th percentile, they're looking increasingly undertaxed compared to those above the 90th percentile. And we might want to look at that. For example, last year, people in that group, 50 to 90%, were responsible for something like 41% of income, but only paid 31% of income tax. At the turn of the century, they were responsible for about 38% of income, paid 30% of income tax. So we could certainly think about raising a little bit of income tax for those people who are above median income, not a huge amount, but just a little. And that would certainly help alleviate the fiscal position. And if we back that up with statements about no more kite flying, no more discussion of other types of taxes, whether stealth or not, I think that would certainly help build confidence and get people ready to get on with their lives and their businesses.
Thank you. That is wonderful. So I think we've heard that we've got some quite large challenges. We possibly don't agree with some of the targets. We've got a lack of confidence that we need to overcome, a productivity challenge. We want to hear that there is more stability, particularly for businesses and the environment. And we've got a rather large investment gap of up to £2 trillion to fill. So thank you very much for some of your thoughts. Thank you to all the panellists today. And that concludes this session. Order, order.
Yes, I'm ready, yeah.
Fantastic. Yep. Okay, there's water there if you need to pour.
Thank you.
So
Thank you. Can you hear me?
Yes,
yeah,
we can.
good.
Okay, so ready? Order. We are now conducting our second panel into financing the real economy. Thank you very much, Will Hutton, for joining us. We've just heard from a number of economists and people with a great deal of knowledge about the current challenge, and I think you've heard some of the points that have been put to us about where the UK is in its hunt for growth and its current position. Where do you think we are, so globally? Where do you think we rank, and what's your viewpoint on where the UK is at the moment?
Well, I'm slightly more optimistic than the previous quartet. I agreed, obviously, with some of the things they said, but this growth trilogy, I hope you've all had a chance to have a. I brought in all its splendour the 3 volumes, all 230 pages of it. 600 footnotes and all the rest of it. But when I began working on this with my colleagues at the Personal Company, I kind of shared quite a lot of the views of that quartet. But I have to say that there are shafts of much more optimism that I've encountered in the last 15 months. And it's qualified. But just an opening kind of remark about, two things. A number of things have happened. Just in the last kind of 24 hours. It falls out. The IMF is saying that we're going to be the second fastest growing economy, not only this year but next in the G7. Of course, Spain and Poland are faster growing, and of course, there's always kind of what's going on in kind of India and China. But I think the UK unexpectedly. Has got no advantages in the kind of big trends of the moment. And I identify 3, or we identify 3 really. One, there's been an enormous growth in private markets globally. They were $3 trillion in 2003. They will be worth $59 trillion in 2033. It's the most phenomenal, if you want to think about it, it's the privatization of capitalism in a way. Growth of private credit, private equity, venture capital, private infrastructure. It's an astonishing, the growth of private sector firms. Only a third, actually, of the biggest firms in Britain are now quoted on the London stock market. It's a huge phenomenon. That interacts with a kind of accelerated process of creative destruction with the new technologies that are coming through. And that's one of the reasons why the Nobel Prize was won by Philippe Aghion and Joel Mogier and colleagues yesterday, creative destruction. And actually, and that opens up the possibility of actually lots of kind of startups, spin-outs, and scale-ups. And actually, it turns out that that the UK lies third after China and the United States in the number of unicorns it's generated in the last kind of 20 years. That's a company whose valuation in the last kind of placing of its equity made it worth more $1 billion or more. That's a thing. We are third in the world in the number of startups. A lot of tax incentives for startups, a lot of angel investing going on, but we really are embracing the new, kind of in an unexpected way. And a lot of these young companies, which I encountered, the tech founders and their venture capitalist backers, are really inspiring men and women. Purpose-driven. I co-chair the Personal Companies. That's kind of on my mind. And they really believe in mission. They're very mission-driven. And in consequence, Britain holds, at the moment, nearly 800 companies whose turnover is higher than $25 million, who are fast-growing. Around 650 of them are so-called colts. That's their size between $25 million and $100 million. And the others are called thoroughbreds, between turnover between $100 million and $1 billion. And actually, we have more colts and thoroughbreds than France, Germany, kind of Spain, Holland, and Sweden put together. As when you start thinking about why our growth rate is the second highest in the kind of G7, notwithstanding the fact that we had that big fiscal consolidation last autumn, and there's another one to come. That's because of these phenomena, in my view. We're an open economy. We have, and one stat you might like to a couple of stats to play around with. Then I'm going to come in with some pessimistic stuff, so don't worry. We do pessimism well in Britain, and I wouldn't want to be part of the party. Not be part of the party, but I mean, Cambridge University, for example, alumni from Cambridge University have created more unicorns than any other area in the world, bar Palo Alto. And they're only narrowly pipped by Palo Alto. It's one of the reasons why Cambridge has become one of the happiest hunting grounds for American venture capitalists, and why the returns actually on investing in every pound you invest in a Cambridge company has on average produced 19 pounds of reward, 19x kind of in the last 25 years. One of the reasons why we have the largest venture capital industry in Europe is because a lot of American venture capitalist companies are here. That's because we are so fantastically brilliant at scientific entrepreneurship. Oxford, Cambridge, UCL, Imperial, Manchester kind of create more successful kind of tech spin-outs and startups than kind of the rest of the university sector kind of in Europe. It's kind of, so it's a big deal. We are sitting on, and here's the problem in my view, and what we say in the Growth Trilogy. Had we had the right ecosystem, and some of the points were raised by the previous speakers, Britain could now have, in my view, a £1 trillion tech economy. We don't need to have just 1% of the kind of FTSE 350 are tech companies. It could have been 30%. And actually, the question to ask is actually how can, in the period ahead, in the next 25 years, we not reproduce the mistakes of the last 25? Because we've got a lot of assets, and then you start to ask how we compare globally. Home bias. Our institutions invest less in UK equity than kind of any other country, and the forward P ratios, that's the forward valuations of earning streams, even adjusting for growth and sector, are actually the lowest kind of in the OECD. There's a wonderful graph by Goldman Sachs. It's on where is it? Page 45. You want to make a look on it after I've gone. Page 45 in paper 3. Our pension funds are far too small, tiny in comparison with the rest of the world. That means they can't actually take the kind of risks that actually other pension funds other pension funds can take. Too many, and I think Tera Allas made this reference. We're brilliant at startups and we're brilliant at scale-ups, but too many of them get acquired before they reach maturity, 94%. And half tend to be acquired by kind of UK companies, and half by companies overseas, largely American companies. And we did a kind of computation that actually, if you take the nearly 3,000 companies whose turnover exceeded $25 million over the last, a typical company that has a turnover of $25 million, if taken out by a foreign buyer, normally the United States, cumulatively that's $5 billion of lost economic value to the UK over a 10-year period. We've lost nearly 3,000 companies in the last decade, which $1 trillion has been kind of exported, if you like. And you don't have to think of kind of ARM or DeepMind to think of some of the exemplars of that trend. We don't take risks as a country. We don't have block holders in our quoted companies who kind of anchor our companies, so that the target rates of return tend to be too high, choking off potential kind of investment possibilities. The stock market has shrunk kind of in the last kind of 25 years from being number 3 in the world to number 9 or 10. There's a lot of things to put right, but some of what the government is doing is moving in the right direction. Pension fund consolidation, giving the British business back some money. And here I would challenge two thoughts. I'm going to stop. Two thoughts that I thought were two or three thoughts really I thought did need challenging from what the kind of earlier speakers said. First of all, Britain, and I think I'm happy to supply the committee with some names of some entrepreneurs and some serial entrepreneurs who I think you should interview. I think you should interview Demis Hasseby, founder of DeepMind. I think you should interview Stan Boland, who's a serial entrepreneur. These men have made serious money, and their strictures on why they weren't able to do more in the UK are well worth your committee hearing, because we've got to put that right in the period ahead. But what Stan will tell you is that, and it puts the points of Tera Allas on our head, if we can find the risk capital, we've got such a dense pool of entrepreneurial talent in Britain, they will come forward to use it. Supply of capital brings forth the entrepreneurs. It's not the other way around. I mean, I do find this, if you want me to, I'd be happy to supply places you can visit, because some of these companies are just inspiring. Pragmatic Semiconductor, which has made the smartest semiconductors in the world, actually. Matillion, kind of fantastic. I mean, I can go on, but it's just,
Oh, that's it. Thank you.
And I want to challenge that. I want to talk about the opportunity.
Well, let me come to one of my colleagues who's
sorry,
got a
I've
question.
not too long.
Let me come to one of my colleagues, because they've got a question that they want to pose to you. So, Joshua Reynolds, would you like to kick off in that direction?
Thank you, Chair. Keeping in mind what Tera said earlier in regards to public sector investment potentially crowding out some private investment, how would you assess the approach that the government's taken to leveraging that public investment to crowd in business investment?
I think crowding out is a particular phenomenon that may happen in particular parts of the economic cycle, but in general I don't buy it. I think that when making investment projects, kind of certainly large companies want to lay off the risk as much as they can, and actually, and one of the roles the British Business Bank is kind of successfully playing, actually, which is the answer to your question, is just that, by being a lead investor, a kind of a role it can increasingly take. Now it's been given the right to write checks up to 50 million for a particular share stake it may take, is a signalling mechanism in the market that crowds in venture capital. And I talked to some venture capitalists. I mean, they will follow the signal the British banks can lead. It's done the due diligence. It thinks XYZ company is worth 50 million, 10 million, whatever the figure is, and it will come in. So I do think that the kind of leverage possibilities of the British Business Bank leading, if the British Business Bank just take Pragmatic Semiconductor, the British Business Bank gets kind of involved. So does Northern Gritstone, the kind of local kind of northern kind of venture capital company run by Jim O'Neill, another person to talk to, I think. Catalyst, kind of a growth equity, kind of £4 billion growth equity division of M&G came in, and so did Cambridge Innovation. And actually, you suddenly see that, and its cap table is still dominated by UK shareholders, and I think it's likely to stay UK owned if it can solve some of the technical problems. It could really come through. So, I mean, I think the crowding out model in that sense, using kind of the British Business Bank and the National Wealth Fund to supply the British Business Bank with much needed capital, arguably the British Business Bank needs kind of the equity gap, which here I strongly agree with what they were saying. The equity gap for scale-ups is 10 to 15 billion a year. We need to find 100 billion over the next decade, 100 billion extra over and above what the current structures will provide. And actually, the only way to do that, in my mind, is venture fund consolidation, allowing super funds to emerge, which can adopt the tiny fractions of capital that are prudent given their size. They can do it, smaller ones can't. They can put some money into a fund of funds that venture capitalists can deploy, kind of in partnership with the British Business Bank, and we can get cracking. And that's a model that I think needs unpacking and exploring. And again, I urge the committee to do that. But that leverage does work, yeah.
Excellent, thank you. Sonia Kumar.
What targeted policy areas do you want to see the government implement to make more attractive for venture capitalists to come in. And what I want to speak about in particular is women, because obviously only 2% of venture capital goes to women, and also looking at those that are underrepresented minorities, such as those with disabilities and those with ethnic minority background.
Yeah, I mean, look, not everything in the venture capital garden is in the second of the papers. There's a whole chapter consecrated to the weaknesses of venture capital, some of which you just adumbrated. But in the round, you only have to look at the American story. I mean, venture capital supplies 0.2% of investment annually every year in the States, and yet kind of half of American publicly quoted companies were venture capital backed, and all but one of its 14 $1 trillion companies were venture capital backed. It is a kind of in the circumstances of today, with equity being the prime thing you need. A risk-taking equity investor is what a scale-up needs, given the fast movement of technology and the pace of creative destruction that's going on. And consequently, it's an indispensable tool. It's the institution you need kind of in the 21st century to kind of get your economy on the move, in my view. What can we do? There are nearly 800 of these fast-growing companies. We don't really know what sectors they're in. I mean, I know one of the venture capitalists, Phoenix Court, run by Saul Klein, who is the most successful venture capitalist outside the United States. He's conducting an exercise to kind of who are they, where are they, and what sectors are they, and to what extent do they map on to the Industrial Strategy 8. My hunch is very significantly. If I was in charge of industrial strategy, and what I'd want to do is I want to make sure that it's all very well talking training and infrastructure, you can do all of that, but you've got to have a critical mass of consequential growth companies, kind of, if you like, they're the horses, pulling the coach. If you haven't got them, it's kind of, it's Hamlet without the prince. So we need to identify who these companies are and ensure that they have the kind of support that they need, and try and ensure that their cap tables are kind of predominantly kind of UK, and keep them in the United Kingdom and as far as we can. Some of them have to go to the United States because that's where the markets are and all the rest. But we need to do a much better job of keeping them in the UK. We need to stop the export of our potentially great companies. Or we can't stop it, but we can certainly curtail it and get the balance, I think, better than we've currently got it. And that would be a major preoccupation for me if I was in government.
Thank you very much. John.
Chair, thank you. Just leading on from that then, so your Growth Trilogies report, apologies, difficult with these teeth, talked about risk aversion and a lack of appetite to take those risks. Government over the years has tried different things to try and change that culture. It's quite difficult. Things like the Mansion House Accords were quite successful, I think, in trying to change the culture a little bit. Some of us were a bit queasy about attempts to prod pension schemes into putting more money into the UK, and you talked earlier on, you mentioned pension funds in this country just simply being too small to really take much in the way of risk. So what do you think the government can do? How can the government engender and foster a culture of risk-taking and equity investment?
Well, I mean, this is a huge story. I mean, I do think that again, on the retail side, we have some kind of numbers. Again, I'm sure you had a look at page 72 of the third report, looking at, I mean, a UK retail saver / investor will disproportionately invest in residential property in cash compared to the list of OECD countries that we compare them with. So it's not just the pension fund trustees; it's all of us. Actually, we don't take risks. And by the way, personally, I think that given where residential property prices are, but we've got to have a figure there where we show that had you put money not in cash as in an ISA, but in equity, over the last kind of 30 years, you'd have been, the money would have been kind of the pool of ISA savings, which is currently around 125, 130, 140 million in cash, it would have been 500 million. So I mean, we're making a mistake collectively in actually not taking risks. And then you have the pension fund side. And I do think that pension fund consolidation is a precondition. It was begun, in fact, in fairness, by the Conservatives in government in 2021 and followed through by Torsten Bell and Rachel Reason kind of at the moment. We do need, we need to get a critical mass of pension funds, certainly above 25 billion in size and hopefully above 50 billion as fast as we possibly can. If we need to build up the Pension Protection Fund, the PPF. We need to get the local government pension schemes to consolidate as fast as we can. I've advocated, and we advocate in here, the establishment of certainly funding public sector. We shouldn't be paying employees in the public sector and without funding their pensions. We need to have introduced funded pensions across the public sector in the health service and in the certainly armed services and teachers and the seniors and the central civil service. And I would expand it, by the way, to make it a kind of a British pension plan that over the next two generations would pay the pension out of accumulated funds rather than on a pay-as-you-go basis of the tax system. We have to have these funds that are big enough to start taking risk, and then we have to incentivize them to kind of invest in the UK. And the home bias is just, we are just so pathetic. We come bottom of the league table for investment in ourselves. Even when you adjust for sectors and the growth character of our companies and all the rest of it, we just don't invest in ourselves. And we kind of, and I personally think that in defined contribution pension funds, they're kind of where the members default the decisions to asset allocation to the investment managers. The presumption should be that 25% of the equity portfolio should be in UK equity. And I think that should be backstopped there's a lot of support for that, by the way, in the city. I think it should be backstopped by the withdrawal of tax concessions if you allow that equity allocation to fall below 12.5%. Now, Goldman Sachs have come out saying that they lean into that, partly because they produced the graph showing that the lack of home bias is why our forward P ratios in Britain are so damn low, and the London Stock Exchange are keen enthusiasts for obvious reasons. But so are a growing number of kind of.
Do you think there's a groundswell toward that? I mean, you're talking about an enormous cultural change there. But
I am talking about if we.
In its favour.
It is in our hands, in our country, to build a £1 trillion tech economy by 2040, or even bigger than that, not to repeat the mistakes of the last 15 years. And the precondition is an acceptance that actually that takes risk. Because as any venture capitalist will tell you, some venture capitalists have never invested in a cult or a thoroughbred kind of in that. There's 4,000 venture capital companies in Britain, and only a kind of handful have actually managed to invest in more than half a dozen successful enterprises. That's why you have to have this fund-to-fund approach in partnership with the British Business Bank. Is why we have to the whole how to finance the real economy in a 21st century economy, the subject of your inquiry. The exam question, it seems to me, you have to answer is you've got to promote these equity flows. We know a priori that many of the investments, aren't going to come through because that's the nature of the beast. The kind of American venture capital industry shows you what's possible, and there's all kinds of reasons, scale and risk appetite, that they've managed to do it, and actually kind of tax breaks and actually clever public procurement through DARPA, etc., well, they've managed to do it. We can do the same. We have a very similar institution structure, and we can, but you're right, that is the precondition, both as individuals and as institutions. And we have to accept that if you want that kind of economy, and by the way, spreading it around the country, some of the gap between kind of the appetite for capital, for risk capital, and the supply of it is most acute, of course, in British regions. Northwest, northeast, east and west Midlands, Yorkshire and Humberside, and the southwest. But even so, in paper one, you'll see that where we look at where the British unicorns are. There's a number in Bristol, there's a number in Manchester, there's a number in Newcastle, there's a couple in Edinburgh. It's not only London and the Golden Triangle. But yes, you're right. That is looking that squarely in the eye and actually using the tax system as far as we can alongside other mechanisms to kind of promote an equity risk culture. And actually kind of the Swedes have kind of social democratic Sweden has actually taken a lead in trying to kind of educate its populace in the merits of risk and its IPOs and its stock market is flourishing. Thank you very much. So, it can be done.
Thank you.
Thank you. Connie Maynard.
Hi, Will. As an ex-entrepreneur, I'm nervous about British business banks and things like this. Generally speaking, I find government makes terrible investment decisions, and just leaving it to government to be doing that and putting more money in on behalf of government to do that, and then also kind of saying, well, you're allowed to do this, but you're not allowed to do that, and you've got to do this, and social policy here and economic policy there. I just did, while we were talking, I kind of did a comparative grid through ChatGPT of what GIC does in Singapore, what the Norwegians do, and what we do. And, we're all over our British business bank and telling them what to do. GIC and Norwegians, Singaporeans and Norwegians, leave them alone. And guess who probably gets the best returns? And so I'm really worried that we just end up putting a load of taxpayers' money into government banks which just do really rubbish business decisions, backing favourites that blow smoke wherever makes it most comfortable, and what's wrong with the private equity and the VC investors? I mean, there's loads of money about. Shouldn't we be working on getting our policy structures better so the business environment, people, carrot rather than stick, people want to be putting money into the UK because it's a brilliant place to invest?
Well, there's some of that happening already, of course. I mean, there is an element of that already, but you have to, first of all, the British Business Bank, does supply kind of between 10 and 20% of all venture capital in the UK. Two, it has created over 50 unicorns. So it's not entirely kind of the crap organisation you say.
Well, I'm not.
No, but it needs to be. Let's call a spade a spade, Charlie. I mean, you did. You were pretty. You laid it into the BBB. I mean, I don't want to kind of. And I can introduce you to a whole bunch of venture capitalists who actually think that having the BBB as a kind of lead investor kind of is a really important signalling mechanism for them. And actually, I don't see any way to grow the venture capital industry to the scale we want it to be, and to close the scale of a 10 billion a year equity gap to support our scale-ups without it. And actually, I think Stephen Wilton is a good guy. I think the CEO is a good man. I mean, I know it has its critics. It's not perfect. I mean, I do think, by the way, that the calibre of people in both the British Business Bank and the Pension Protection Fund is very high, and I would want to give the PPF I think it should be given a greater role in the consolidation of DB pension schemes it's currently got, and I think that's another part of the jigsaw. Too much of that kind of more than £1 trillion of defined benefit pension money is kind of lying idle, in my view. Half of it probably does need to be crystallised and annuitised, but there's another half of it could be invested in growth equity, certainly in public equity, because the story, it's not just venture capital, it's also having kind of vibrant public markets. If we want to get a flow of consequential growth companies to stay anchored in the UK, and that means having IPOs here, and that means having a vibrant public stock market. And I think, a rising stock market is a bloody good thing. And we need to talk in these terms much more than we do.
Well, I'm not, it's not about the British Bank I'm referring to. What I'm referring to is operational independence.
Totally. I mean, absolutely totally. I mean, I think that is totally. We are as one, shoulder to shoulder, 100%. Got to give them operational independence. And to the extent that they don't have it, and again, that would be a very useful thing that you as a committee could do, is to kind of prioritise that and actually tease out from the leadership team at the British Business Bank where they have it. I mean, I think they probably are lent on a bit too much. On the other hand, it is public money. They are aware of their responsibilities as a public institution, and you know, you represent constituencies all around the country. I mean, it's the best we've got in kind of its representation in the Midlands and the north of England and Scotland. I mean, you know, we need it, and certainly venture capital isn't going there of its own accord, and it will be pulled there by the BBB. So, I entirely agree. It must have operation dependence, must be given the freedom to decide what's commercially viable or not. And if it doesn't want to make an investment decision because it doesn't think it's going to work, it must be free to do that, absolutely. And alternatively, to scale up if it thinks it's necessary, even if it's in the, you know, even if it's in the Golden Triangle in Oxford or Cambridge, which have got so many winners already. If it sees something it should back there, it must back it.
Thank you.
Brilliant. Thank you. And final question from me. We've had a number of investment summits so far that seem to have been very positive, and we've had a lot of people talking about the types of investments they are going to make. In the West Midlands on Monday, we've got a regional investment summit, and we've got obviously a regional mayor, Richard Parker. What message would you send to him and those investments ahead of, and those potential investors ahead of Monday?
Gosh, look, I mean, I think, you know, I mean, the West Midlands, I mean, thank God, Jaguar Land Rover is resuming production, actually. I mean, there's three things I think you have got to get right to get a growth story going. I mean, actually, there's more than that, probably. But actually, I mean, you've got to get the productivity up in the foundational economy, and I include the public sector in the foundational economy. I mean, actually, I can send you some stats which shows they were going on about the collapse of productivity in the health service, correct. But actually, it's not fabulous in retailing either, actually. It's not fabulous in utilities. You know, there's a lot of privately owned areas of the foundational economy, like the NHS, where productivity is really not very clever. And so you've got to get the story right in the foundational economy. That's about training, incentives, and actually I think kind of it's where actually the lack of investment kind of has its kind of biggest adverse consequences. So that's one thing you've got to get right. Secondly, I think you've got to, once you've got that right, the next story is the future economy. And I would urge that I don't know, and I wanted to get the figures together for you. I'm hoping I will be able to get them for you before you finish your work on, for example, how many of this, it's 770 actually, colts and thoroughbreds, where they are. I would expect at least 50 of them to be in the West Midlands, and I bet you that no one knows who they are. They might know half a dozen of them, but I don't know who the whole 50 are. And, you know, then you need to identify them. You need to organise their clustering. You need to make sure that kind of the mayor and the public authorities are doing all they can by public procurement and kind of training and making sure that the talented people are on the ground for them to hire. You know, that would be my message. And if you get those two things right, the inward investment will come through. So I mean, you know, and you'll keep Jaguar Land Rover going strong. If they feel they're nested in a kind of, I mean, and you've got some wonderful universities there. I mean, so I wouldn't, in some advanced manufacturing going on in Coventry and Warwick. I mean, it's not. I mean, there's a lot to build on. So that would be my message.
That's excellent. That's fantastic. Well, very uplifting, as we've obviously heard from our previous panel, the extreme challenges that we face, and I think the short-term versus the long-term challenge. There's certainly a very well-made point about getting the growth narrative clear and the future economy that we all obviously want the UK to benefit from. Yes.
I just want to, there's a couple of other things I want to say before I go. I mean, I said most of it. I mean, there's a whole public and procurement story. There's a corporate procurement story, where you talked about risk, John. Our corporations just do not take risks in sponsoring their investment in their supply chain, in actually supporting their supply chain. I know a number of fintech companies that have gone to kind of New York because they can't persuade UK financial houses to support our fintech sector. There's just not the same kind of attitude to risk, kind of in not just public procurement but corporate procurement. I also think that taxation should be organised so it's much more contingent. We discussed withdrawing tax relief on pensions. I also think that if a US company takes out one of our major tech companies, I know that Innovate are thinking in these terms, but the grant should be repaid. The UK taxpayer should not get nothing back from support, 5-10 years of support for XYZ company. Much more contingency, and there should be much more contingency in R&D, and much more contingency on corporate. You asked about the other panel about tax in the budget. I mean, one thing I would do is I would introduce contingency across the piece. I mean, 100% corporation tax allowance, yeah, but I want to see additional investment next year. R&D tax credits, fine. Additional investment, please. Let's see some consequences of these tax breaks, and some phasing, and the tax concession is in peril or imperiled on a taper to be worked out if it isn't following through. And lastly, and it's anathema, I think, to raise it in a sense, but I do think it's important, and I think that Adair Turner mentioned it. The statistics are quite awe-inspiring. London, Oxford, Cambridge, the Golden Triangle, Bristol, Manchester, Edinburgh, and to a degree Glasgow actually with the space sector, and also on the Eurostar down back to Paris, and actually Eindhoven, where Philips is based. You have the densest concentration of high-tech and startups and scale-ups in the world outside Palo Alto, and they're calling it in the trade the new Palo Alto, the new Palo Alto. And actually there's a labour market in there. If you're a scale-up in Cambridge and you want a chief investment officer, you might recruit her from Eindhoven, and they might recruit a chief financial officer from Manchester. There's a kind of, and actually it has to be kind of recognised that actually the tech economy is actually making a nonsense of Brexit. And actually it's not just the story I know is about kind of getting in the kind of the customs union or the internal market, but I mean something that would fall short of that, but actually would produce rich dividends, is creating an EU innovation area. And some of the venture capitalists, British Venture Capital Association, others, are kind of advocating a thing called EU In, which is a kind of EU innovation area. And again, I mean, I think that would be a very, it's not kind of the whole fandango of rejoining the European Union, but it would be, and here's the point, if we get our ducks in a row around the lines I've suggested in this growth trilogy, and my colleagues and I have suggested in this growth trilogy, and we really become, and it becomes obvious that we are going to become the third biggest tech economy in the world after the Chinese and the Americans, with a whole series of specialist areas where we are making ourselves best in class, we'll become a mecca for not just our own venture capital money, but EU money from the rest of the EU, talent from the rest of the EU. And we should regard that as a wonderful opportunity, not as an infringement of our sovereignty.
Thank you so much. That was really helpful and really enlightening. Thank you for sharing your insights from the growth trilogy, Will, and thank you very much for answering the questions so helpfully. I think we've got a lot to take away with us and some positivity to investigate as well. So that concludes this panel. Order.
Thank you.